Today on InvestTalk, we look at the costs of Thanksgiving dinner. We also unpack why small caps surged today, then answer questions about Alerian MLP, APLE hospitality, dividend reinvestments, and more. And at the end, I look at what record insider selling means for markets.
This is InvestTalk, independent thinking, shared success.
Now, our main focus point concerns this topic, how to celebrate Thanksgiving without overspending. And this is a very interesting report coming from LendingTree. They surveyed over 2,000 U.S. consumers and what they were planning on for Thanksgiving. Now, the average host is expected to spend $431 on food, drinks, and decor, up 19% from last year. And 36% of them admit doing so is a financial strain and may even put some of them in more debt. Now, there's some great stats coming out of this and some very insightful ones. Over half, 56% of Americans may host guests for Thanksgiving this year, and spending on average, like I said, $431. But if you're a six-figure earner, you're spending nearly $600, $579. If you're a male, $496. So men tend to spend more. Maybe we're just not as good as frugal, not as frugal shoppers, maybe as our female counterparts. And parents with young children spend $493, and those are the ones that expect to spend the most on the meal. Now, 60% say inflation is impacting their Thanksgiving. 27% will change food choices, and then what else? Why did I do that? There we go. I skipped ahead. It's been a day, guys. It's been a day. There we go. I have the numbers in front of me, and then it just decided to jump around. Okay, so 26% will use a coupon to fight inflation. 9% won't host at all due to costs. Okay. Now, over about a third, 36%, of hosts admit they plan to spend on Thanksgiving. What they plan to spend will be a financial strain on them. So that's over a third. That's crazy. 14% already regret it. Now, maybe that's the cost. Maybe that's just dealing with family. Who knows? But 34% of potential hosts will use their credit card to pay for Thanksgiving costs. That's pretty crazy. Now, 6 in 10 potential hosts expect their guests to offer money or bring an item to offset the expense. So if you aren't bringing anything, remember most hosts expect that. 25% say they may reconsider an invitation next year if their guest does not show up with anything, right? They show up empty-handed. Now, with the majority of those attending a celebration will bring something. 63% will bring a side dish. 32% will bring dessert. So younger than 18, they are more likely to have 68% of those will host. 66% of those with six-figure earners will host. And I love this one. Gen Zers, age 18 to 27, 63% of them are likely to host. Just shows you the young generation, they love being together. They love the community. They love the family aspect. Despite what I think a lot of people think. I thought that was a very interesting number that just showed you how important it is to those young people. What can you do to help? Even if you don't have the money, well, offer. Show up early, help cook, pick up family from the airport, do things like that in order to do your part. Doesn't necessarily have to be, you don't have to be a great cook. You don't have to contribute a ton financially. Sometimes it's just being there as a resource. So think about that as well as you head into your holiday celebration with your friends and family. Elevate your investment strategy by joining the KPP Premium Newsletter. Subscribe now for expert insights and tips. Let's take a quick look at the market today. It was a decidedly positive day overall, but certainly didn't close strong. I should say that. If you look on the day, we had some pretty big movers in both directions. Tesla was down 4%, Netflix down 3.5%, Oracle down 2.2%. You had Google up about 1.75%. Nvidia was down 4%, however. And Amazon up 2.2%, Apple up 1.3%, Microsoft nearly flat on the day. But we definitely sold. We came off the highs overall, and this was all because of President-elect Trump's confirmed Scott Bessent as the Treasury Secretary nominee, and he's considered to be a market-friendly pick. He has support for tax reform, and deregulation. But he does say he wants to tackle the national debt. And he wants to do it in three ways. Cutting the budget deficit to 3% of GDP by 2028, so the end of the Trump term. Drive 3% GDP growth through deregulation. And produce an additional 3 million barrels of oil or its equivalent a day. Now, I see big challenges with all three of these. Now, the first is cutting the budget deficit to 3%. We're at about 6% now. So where are you going to come up with those savings? We know that the vast majority of spending is non-discretionary. So you'd have to reform entitlements somehow. That's Social Security, Medicare, and then obviously interest on the debt. You can't really do much about that. It's hard to really manage the level of debt that we have. So I think that's going to be a challenge in and of itself. And then driving 3% growth just through deregulation, I think that probably has the most potential for helping. But, where is deregulation really holding back parts of the economy? I don't really see a lot. There aren't a lot of places where government is preventing a lot of growth. And then 3 million barrels of oil equivalent a day. This is one of those things where prices have to go up to incentivize drilling, right? So you can't really force oil companies to drill more if it's not economically viable, okay? And they currently have plenty of places to do that. But needless to say, this has been it's been accepted nicely by the markets. And I think that is what you saw today. You saw the interest rates down on the 10-year. So that brought a lot of housing-related stocks up. ITB, the home construction index, so all the home builders, was up nearly 5% on the day. And that's because if you look at the 10-year moved down. Let me pull this up here. Closed the day at about 4.25, and the recent high was closer to 4.5. So we're down about 25 basis points over the last week now on the 10-year. So that certainly will help mortgage rates, et cetera. So that was the market today, and a very interesting day in markets because gold was down, and what else did you have down? You had oil prices down, as you would expect, with this announcement here. Let me pull up a few other things. Okay. So, small cap value was up nicely today. Large cap growth was actually down on the day. That's what's interesting with Nvidia down, Tesla down. What was the other names that were down? Oracle down, Netflix down. So that was really the weak part of the market today. And small caps continue to do well. Lower rates certainly help. And this would be lower taxes. Tax reform would be more friendly to those small businesses versus the large cap companies. So that's what you saw in the market today.
Hi, this is Carlo from Rhode Island. I was trying to get your idea about APLE, Apple Hospitality REIT Incorporated. Thank you.
All right, looking at APLE. Pull this up here. There we go. Like I said, today's been quite the day for me. So if I'm a little slow today, a little off, there you go. All right, Apple Hospitality REIT invests in income-producing real estate, primarily in lodging sector in the United States. And this is an area that was hit with the pandemic and has come back pretty nicely. They invest in upscale service hotels. It operates under the Marriott and Hilton brands. And, this is one of those REITs that they license, the name brand from Marriott, from Hilton. And I think a lot of these aren't very well run. They're pretty, I don't want to say too much about Apple itself because this could be one of the better run ones. Now, their earnings are continuing to move higher year after year. That is a positive. Revenue growth, 6% last quarter. That is a slowdown from late 2023 when more people were traveling. So certainly travel has slowed to a trickle. If you look at, let's look at its profitability, return on equity around 6%. That's okay. Free cash flow, $300 million on about a $4 billion market cap. So pretty good free cash flow yield there. The technicals are just okay. They're not terrible. Here's my issue. This is okay. It's okay. Are there better REITs out there? Yeah, there's a lot of better REITs out there. Are there worse REITs out there? Yeah, there are a lot of worse REITs out there. This is just okay. You're getting a 6% dividend yield. You're probably chasing that. Can it sustain this dividend? Probably not. A lot of people will look at this and they'll probably say, "Oh, I want the monthly dividend." That's what's enticing a lot of people to this. It pays 8 cents per month. I get this monthly income. Sounds great. But what you have to realize is pre-pandemic, their dividend per month was 10 cents. Now it's down to 8 cents. And, the big question is, why is that? Why, what's the step down in yield? Is it because they have too much debt? What is it? So, I wouldn't be chasing it just for the yield. I wouldn't be chasing it just for that monthly income. I think it's one of those okay REITs, but you could do much better if you do some deeper research. Thanks for the call. Now, we've been telling your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play, as well as our YouTube channel in video form. And we have questions submitted over there. And JDude88 says, what do you guys think about XSVM as a part of my small cap portfolio in my IRA? Okay, this one's very interesting. Here you have, let me go back here. I had it up. So this is the Invesco S&P Small Cap Value with Momentum ETF. So this is I don't want to say it mirrors. It's similar to kind of what we do for our clients. We don't focus on small caps. We focus more on the mid caps, but large caps and small caps as well, but more on the mid caps. This is focusing on the small caps, and then it layers on momentum, which is an important factor and something that we consider as well when we are building portfolios. So I like, and then it's the value side, right? Tilting on the value side of the market. And obviously small cap value did very well today. So this one did very well as well. Let's see, what was it up today? There we go. Yeah, up nearly 2% on the day. So I don't mind this. I think there's definitely, this is probably better than buying the Russell 2000, for example. This has 114 names, so certainly more concentrated on those names that have good momentum, are on the value side of the market, et cetera. So I have no problem with XSVM. That is the Invesco S&P Small Cap Value with Momentum ETF. Now, here's one issue. I will say, backtrack real quick. It's S&P Small Cap. This is only 600 names. The Russell 2000 is 2,000 names. And so this is obviously shrinking those 600 down to 114. We like the Russell 2000 over the S&P 600. Both are considered the small cap index. But so just to clarify there, I would rather it be momentum on the Russell 2000 as opposed to the S&P small cap. But hey, it is what it is. Now let's play another question for you now.
Hello, this is Randy, the truck driver from Iowa. Now I'm in Illinois today. I have a question. Some time back, a year or two ago, I heard you talk about dividend reinvesting, and that rather than let the dividends go back into the company for reinvestment, to hold it in your sweep account, and therefore you could choose where you wanted it to go. I'm curious, is that still how you feel, or is it better to just let it be reinvested back into the company? You have a great show. I have learned a whole bunch, even though I still don't know hardly anything. Thank you very much, and keep up the good work.
Appreciate your call. And the answer to your question is it's mixed, because how we do it, we take the cash into the sweep account as opposed to reinvesting in the stock. But we are looking at our strategies and our client accounts daily. So we're very hands-on. We're looking for opportunities, and we want that cash available when those opportunities present themselves, because most of our strategies have anywhere from 25 to 40 different names, and one might pay a dividend, and this other one might have pulled back to a good buy point. We want to redeploy some of that cash in this other name that we think has better opportunities today versus, when you do a DRIP, dividend reinvestment plan, you're automatically putting the money in when it pays the dividend. It might be a good time. It might be a bad time. You don't know exactly. So we rather have a bit more control. Now, if you aren't on top of it regularly, then maybe doing the drip makes sense because you're not really actively finding the right time to get into, to deploy that cash. Okay, so it depends on what type of investor you really are.
Good day, gentlemen. This is Jim down in Miami, Florida. I'm calling today about Liberty Energy, ticker symbol LBRT. You gentlemen are really good at finding out the nitty-gritty about these stocks. So any information about Liberty, and if you would recommend as a buy it now at this entry point, that would be great. Thank you so much.
All right, looking at Liberty Energy, and this is in the oil service business. So this is the type of company that surged after the after the Trump election. And this sector has kind of fallen off a little bit. Now, Liberty, it's a smaller cap name, about $3 billion market cap. And it's an oil service company that provides hydraulic fracturing services, mainly pressure pumping, in North America. And it acquired Schlumberger's OneStim business segment made Liberty one of the largest pressure pumpers in North America. Okay. And so this is pretty big in its niche. I will say that. And its profitability is good, about 19% return on equity. That's positive. But if I zoom out, it's not usually as profitable. So that worries me a bit. Now, free cash flow is about $361 million. That's good. A $3 billion market cap. I like that. Good free cash flow yield there. Not a lot of debt. I like that. My issue is the chart. It's just in a downtrend. Simple as that. It peaked back in June, and it's making a series of lower highs and lower lows. And it's being constrained by the 100-day moving average. And it recently rallied. Actually, today it nearly hit that, and it closed near the low of the day. So pretty big reversal on the day. I don't really like that. And I just don't love the oil service names. And this has earnings are supposed to fall 43% this year and 20% next year. Yeah, they made a record $3.16 last year. And if you base on that number, it looks cheap, an $18.72 stock. $18.72 stock. There we go. So yes, based on that number, it looks cheap. But if you go based on forward-looking earnings, $1.43, you have a mid-teens multiple on a shrinking business. I don't love it. With poor technicals, I don't love it. So I would keep it on my watch list because it's not a bad company. It's not a bad oil service name by any means. It's just has poor earnings trajectory as well as chart price trajectory. So for those reasons, I'm going to pass on it. Thanks for the call. Now let's talk a little bit about inflation. It's been the word of the post-pandemic era, especially when you're talking about the economy. It was always about growth, right? Inflation never kind of bounced between 1.5% and 2.5%, kind of in that range, not to any levels that most people cared about. They didn't feel it. But when inflation surged to high single digits, maybe depending on what measure you're looking at, maybe low double digits, suddenly it woke everybody up. And now you have a president-elect that, he has I would say a very mixed history. A lot of people, the Trump term was generally good for the market, generally good for the economy, but there were some rougher periods. Think 2018. I don't know if you remember, the market was selling off into Christmas pretty hard. A lot of that had to do with the tariffs. And his tariffs were, they were minor in the grand scheme of things. And Biden kept them, but the market or the market got used to it, and sectors got used to it. They adjust their supply chains, the currencies adjusted as well, and all of that eventually leveled out. It required a easing cycle from the Fed in order to kind of resuscitate the market, but in the economy. But that's what happened then. And now he comes in talking about tariffs again. And who knows how this is actually going to manifest itself in policy. We will see. And that's why the market is reacting based on Scott Bessent's nomination today. And the market will continue to do that. But this isn't really about finding that next move on whoever the market likes or dislikes next. It's really about where is the economy going over the next 2 to 4 years. And inflation is a big part of that. So inflation comes from two sides. Either supply shocks, we saw that with COVID, or demand surges. Now, tariffs and deportation, that is what we call a supply shock. Right? Supplies become more expensive, more limited, because it just doesn't make economic sense in certain instances to continue to produce certain goods. And then you have a labor shock, right? Lack of labor. And that all pushes up inflation. And that could hit the economy. And this is showing up in market moves for what's called break-even inflation rates, expectations going forward. It was rising into the election and then surged post-election. Now, what could be the sources beyond just the tariffs and labor to inflation? Now, the first would be oil. Right now, oil is kind of in a range. I don't expect it to surge. I don't expect it to drop precipitously because I think you'll see oil drilling grind to a halt below $60 per barrel. Even though Trump says drill, baby, drill, it's really up to the executives of the energy companies to actually do it. So I don't think that will be a source of inflation. Stronger growth, though, I think that is potential. Talking about weakening the dollar, that would be inflationary, but it would be good for the overall economy. But there's an area that most people will invest in order to take advantage of a stronger economy in the commodities markets. And that would really be copper, Dr. Copper. Only issue here is that China is a big swing factor here. And so I don't think necessarily this is going to be driven by domestic growth. Okay, it's going to be more driven by Chinese growth. Commodity markets are tend to be driven by Chinese growth. And the last is going to be the nuance of inflation driven by tax policy, for example, as well as what happens with the dollar. Is the Trump administration going to be successful at lowering the overall value of the dollar? They haven't so far, right? They're obviously not in power, but the market's pricing in a stronger dollar. And I think that will be a huge factor in inflation as well, whether they can battle. The tariffs tend to be dollar positive, and that's why the dollar has gone up. So if they can maybe not do tariffs as strongly as the market is expecting, as well as find other ways like forcing the Fed to lower rates, for example, as well as, there are other things they can do to kind of bring the dollar down. And I could see them finding ways or attempting to dampen down the dollar, and that would raise inflation. Now, what industry has the most exposure to illegal migrants? That would actually be the ag market. So I think that's where you'll see a lot of inflation. Problem is that that's a tough market to invest in. It really is. It's very volatile, and there's just not a simple way to hedge against that inflation risk. Now, what are the best ways to hedge? Tips. Tips would be number one. Simple. Now, it doesn't protect against big surges in 1 year. It's more about protecting over the long term, that long-term rate of inflation. And then gold. Gold is another one where I think we'll continue to do well in an environment where other central banks are buying a lot of gold, and it's going up even though the dollar is going up. So imagine how much it's going to go up when the dollar goes down. Okay. So I think that would be another great place to hedge against inflation. Those would be my two best ways, frankly, gold and tips. Now, 2024 is moving fast, and proof is that we are plowing through the fourth quarter, and Thanksgiving is just a few days away. And there are new trends emerging post-election and as we head into 2025. And 2025 is going to be a much different year than this year. I think it's pretty clear. As simple as we just have a new administration, new laws, new objectives, and that's going to create more volatility. Now, that could be more volatility to the upside or the downside. And it could mean both directions, right? Certain things rally the markets, certain things bring the markets back down to earth. And then liquidity. Liquidity conditions will continue to potentially ebb. I think in the back half of next year will be the most risk. But the big question for you is, are you prepared for these trends? Are you too exposed to the sectors that are likely to continue to underperform? Think healthcare, pharma, biotech. Are you overweight the sectors that have done well and will likely continue to do well? Think consumer discretionary. Think energy. It's actually done well so far. Think industrials. Think financials. Is your portfolio aligned with these market trends? And that's where my company, KP Financial, comes in. That's where we practice parallel investing, which means we invest right alongside our clients. And we provide unbiased guidance both on and off air. So I encourage you to take advantage of our free portfolio review assessment via telephone or Zoom meetings. Just send us a message through InvestTalk.com.
This is Glenn in San Francisco. I'm a relatively new listener, but learning a lot. So thanks for what you're doing. My question is about trend following. If I'm following a stock and it starts to move up above its 200-day moving average, what strategy do you recommend if I'm looking to buy that stock or ETF? Do I jump on it right away? Do I wait a few days, make sure it maintains that level? Do I look at other indicators? What's your recommendation there? Look forward to hearing the answer. Thank you.
Well, this is a tough one because it's not a simple answer. This is the 200-day moving average is the standard long-term moving average that kind of marks that the price trend is higher over the last year. Because, you have roughly 200 days in a calendar year when it comes to trading. Okay. And a little bit more. Yeah, I understand that. But 200 is kind of that standard number. And, I like to look at it more like if it closes multiple weeks above the 200-day. So I would probably wait for that. And I would also make sure that it's above all the major moving averages. I'm talking the 100 and the 200 as well. Because what can happen is a stock can be very choppy. And it can move above the 200, but it could be still below the 50 or the 100 day, depending on, kind of how the price movement works out. So I like the 200, but I really frankly, the 100-day to me is the one, if you're trying to be a trend follower, the one that makes the most sense for most positions. 200 is a little slow. And the 100 has a little bit more. It still typically sticks with the most trends. Stay above the either 50 or the 100. So I would focus on those two. And I just look at like GLD right now, the gold price. This moved above the 100-day moving average in October of 2023, so about a year ago. And it's been in an uptrend ever since, and it's held. It's hit the 100-day moving average 3 times since then, and it bounced right off of it. And so as long as it stays above that, the trend is in place. If you're trying to be a trend follower, that's a much better one to take a look at and adhere to. Okay, because the 200-day, that one, it can be all over the place depending on how the chart pattern looks. So I would focus on the 100-day over the 200-day.
Thank you for watching.
If this video was helpful, please give it a thumbs up and subscribe to catch our upcoming videos. Now let me drop another question from our InvestTalk YouTube channel. Ben Severn says, is AMLP a good investment for a Roth IRA, and how do MLPs work in general? Now, MLPs are master limited partnerships, and that's what they are. They're limited partnerships. And the biggest issue with limited partnerships is that they have big K1s, and you don't want to hold these in tax deferred accounts like 401ks or IRAs. I think you get over $1,000 in income from them. You have to file a separate tax return, get K1s. It's a big pain in the butt. The Alerian MLP ETF, AMLP, it has its claim to fame is that you don't get a K1. You can get access to, limited partnerships, these MLPs, without the tax consequences. I believe that's still the case. That's the last thing I heard about Alerian. If that's the case, then this would be a good type of vehicle to gain access to master limited partnerships without those K1s. So I kind of like that in general. So I don't mind it. Master limited partnerships, I tend to like them. They tend to be good businesses. What they do is they typically own pipelines to move commodity products, typically oil and natural gas, from point A to point B. And that tends to be a very good business. So outside of these, the MLP, I don't love them as much. They can have their place, but that tax burden tends to be my biggest issue. So as long as AMLP doesn't have that, then I think it's a good place to allocate capital in a 401k or an IRA for small exposure. Thanks for the question. Now, lastly, let's get into insider selling. A record number of U.S. executives are selling shares in their companies. So these corporate insiders are taking advantage of the Trump bump. And sales by executives in the Wilshire 5,000. 5,000 is one of the broadest indices of U.S. companies. This includes one-off profit-taking transactions as well as regular sales triggered by executives' automatic trading plans. So this is a combination of factors. But it's saying, hey, people, these executives are cashing out. Now, to their credit, before this, the previous 3 quarters, insider selling was below average. So maybe they're just catching up here in the last quarter. Or maybe they're saying, hey, these valuations are a bit frothy. And insider selling versus buying at financial institutions was last this high in November of 2016, right after Trump's first win. And in the industrial side, it had its highest level since 2017 before all the tariffs. Okay. Now, what's interesting here is that most people would say that this is the top because insiders are selling. Well, generally, actually, they tend to be 2 to 3 quarters, early. So that would put you probably second quarter of next year. When this has any predictive power, maybe the third quarter, sometime middle of next year, let's call it. And it's what I've been kind of saying. I think this market has more legs to it, but you're getting into the latter innings before there's some sort of I think there'll be another 2022 type of environment where interest rates rise, multiples contract, liquidity becomes less abundant. But I think that's at least 3 to 6 months down the line. And that's what this indicator is telling you as well. And then you look at specific companies. Goldman Insider sold a ton. It's up 12% since the election. Tesla, the main one, up 35% since the election. $34.6 million from insiders have been sold. And then Trump Media, that's number one, sold $16 million since November 8th. Not a shock. And Palantir, up 48% since the election. Also big cash outs as well. Once again, they tend to be a little early, but this does have some predictive power a few quarters down the line. I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. And remember, we can help you better understand your portfolio dynamics post-election and calculate your investor risk number if you head over to investtalk.com, click on the portfolio review button. This is a free and confidential service. Independent thinking, shared success. This is InvestTalk. Good night.